volunteering to bring us all together. So before I jump into our presentation, just want to mention that everything that I covered today is for education and information purposes only. And the financials that I cover are not guaranteed. Past results are not indicative of future results. And there are risks associated with real estate investing. Quick highlight of my background. I've been here in Sacramento for 21 years. I started off in government, worked in the state capitol for Senator Don Parada, then the lieutenant governor, then a congressman. Actually, in 2013, I was the only Asian campaign manager for a congressman. It felt like an incredible honor. However, in 2015, my mom got sick, had health issues, and so I needed to make more money. My parents are immigrants, and my mom had to retire prematurely as a nurse. And so I went into real estate development 10 years ago. And after each real estate development project, I took those proceeds and bought rental properties. And long story short, now I've done over $75 million in real estate deals, 24 million in total assets under management, 100 rental units. But the most important factor is I helped my parents retire. And in that process, I am now quasi-retired too. And this is what the, actually now 16 properties look like. And what's interesting about the 16 properties is that they're all in Sacramento. And that in itself is the first superpower. Like that I can drive to all of my properties within 3 hours. So I found that my property managers cannot bullshit me, or if my property managers need help, then I could lend a hand. And then what you'll see is that there are different investment strategies as well. And Aaron actually inspired me to put it on a spreadsheet of 24 million total assets under management, and eventually will be 150 million. But let's start off with top line market data. This is as of today. The mortgage rate right now is 6.6 to 6.67. Fed rate holds steady at 3.6. And so we're talking about, if you get a mortgage right now, 30-year fixed, we're talking about trend point is 6.65, and headline inflation, we're at 4%. So if your rental apartment is not including 4% rent increase every year, it means inflation is crushing you, right? So that is just the reality of how bad inflation is right now. And so why Bigger Pockets calls it not a market crash. Many folks in 2023 were like, oh, the market's gonna crash. That actually hasn't materialized, but we are in what they call a stall. Like if you drive stick shift and you like stall your car. And why? Since 2023, the historic rate hikes where the Fed increased the rates 11 times in 1 year, the Trump tariff war, 60 countries got hit with tariffs, and that increased inflation, supply side inflation, the highest since the pandemic, and the Iran war with the global shock, the shock in global energy supply side, also incredible inflation. And yeah, the Iran war, just think about it. In February of this year, interest rates were 5.99. However, as of today, interest rates are 6.65. So if you actually do the math, like for any rental property, your mortgage is almost double at this point, just from less than 60 basis points. And if the war continues, analysts are projecting another 70 basis points to inflation. That would be very bad when it comes to interest rates going down. And of course, everything tracks, interest rates track the 10-year treasury bond yield, not the Fed rate. And in that sense, the spread between bond yields is actually down. It's at the lowest it's been at 1.9%, used to be 3.2%. What are the realities? We're in a lock-in effect. A lot of folks are not buying. So transaction value is 35% below normal values, and real estate prices are flat, actually, which is good because a lot of people thought it was going to go down way worse than what it is. We're seeing, maybe 0 to negative 1%. But if you look at it in 2022, price growth was 10% that year. 2021 was 18 to 20%. So we're definitely cooling off and we're slowing down. But what we're seeing in a lot of rental deals is cap rates are lower than financing rates, meaning the deal cap rate, its performance is lower than the interest rate. That is called negative leverage, and that is a very dangerous place to be in real estate transactions. Other market realities and headlines, Interest rates are probably not going down, right? Even Kevin Warsh, who Trump chose to lower interest rates, has reverse position. We're probably going to raise rates this year, right? Deals now need significant more equity. There used to be a time where you could put 10% down, 20% down. That is just not the reality anymore. We're talking about 30 to 40% down. And if you're doing single family rentals, it is not cash flowing. Even single family rentals out of state are barely cash flowing. And multifamily and industrial is not doing that much better either. Rents are flat, prices are flat. Still better position than single family, but it's tough. However, real estate is still way less volatile than the stock market. I mean, if anyone was watching the stock market this week, I mean, AI, memory chips just took it was a huge dip, like 10%. A couple weeks ago, Micron dipped another 15%. This is very volatile. At least we know real estate is not that volatile. And of course, there's an incredible amount of tax benefits for real estate. So what is the big idea of our presentation? 2026, you can still do deals. Actually, I want to ask, who has done a deal in 2026? Raise your hand. Okay, amazing. So there are folks still doing deals. Our group, we've closed on 4 deals this year and in contract in 3 more deals. So that's 7 deals this year, and that's the impetus of writing this book and this presentation. The 6 big ideas that I'm going to cover, and the main one that I want all of us to think about is who has readjusted their investment thesis. So raise your hand if you have a written investment thesis for your real estate in 2026. So this is going to be very important. This is the main big idea of today. If you had an investment thesis from 5 years ago, sorry, it's outdated. Even if you had an investment thesis from 3 years ago, sorry, it's outdated. You need to readjust your investment thesis for 2026. And I'm going to cover all of these other big ideas. Let's just jump right in. All 48 laws are here, so if you want to take a snapshot of this. And also, I'm going to go super fast. The only way I'm going to get 48 laws in this presentation, I have to go 30 seconds per law. So I'm going to go super fast. There is a way for you to get this presentation, at the end. So I'll talk about that. So first big idea, you have to prioritize not your next deal, but your portfolio, right? The reality is you need not a next property mindset, but a portfolio mindset. You need a vision of what that portfolio looks like, and you need to design it proactively. Why? Because one property is not going to achieve all of your real estate goals. It may achieve none, maybe one, but there's 7 real estate investment goals, and the time of buying one property and achieves cash flow, appreciation, amortization, depreciation, all the tax benefits, those times are gone. So you want to think portfolio. Think about the next 4 deals you're going to be doing. And then number 2, when it comes to real estate deals, it actually has nothing to do with buying a property this year. It might actually not be buying a property. It might be reinvesting into your current property, repositioning, restructuring, refinancing, or buying a property with someone else. So what are the 7 objectives as a real estate investor in any deal, right? So in any deal, you're looking to achieve these 7 potential goals. Cash flow, right? In Sacramento, I look for at minimum 6 to 8% cash-on-cash returns. Appreciation. Sacramento, we are on track, still at 3% annual appreciation. I know it's down, we're down 1.5%. However, on a 5-year annual average, we're still up 2.5 to 3%. And then amortization, that is the fact that a tenant is paying down your fixed rate debt. That in itself is a return on capital. And then depreciation, which is about 3%. If you add that all up, that's about 11 to 17%. That's what I'm looking for in a deal in Sacramento. And then there's equity multiple, the idea that your real estate is going to IPO. And then that's anywhere from 2.5x to 3x equity multiple. And then equity recycle and tax deferral. 10 years ago, you could buy a deal in California and you can achieve all of them. Now you can't. If you try to, you're going to wait for a unicorn that doesn't exist. So what you need to do is think about your portfolio. How many of your properties in your portfolio can achieve which objectives? So what are your portfolio goals? There's growth. That's get access to a new property. There's optimization. It's not actually buying a new property, right? But you are reinvesting. You're going to take your long-term rental, you're going to turn it into a short-term rental. Or you're going to take your long-term rental, turn it into co-living, right? You're optimizing the returns equity, or you're going to transition. You're going to level up into a better property, right? Where you're not actually, you're just taking all of the equity there and 1031, and or you're transitioning, do estate planning for your children. And ultimately, you're doing diversification, where now you're going to achieve all 7 of these objectives that I covered. So my main punchline for you all is, in this year, prioritize the portfolio goals over achieving the 7 real estate investment deal objectives. I just feel that it is a much more fruitful and productive goal and mindset to have. So what do I mean? So portfolio, any deal that you do in real estate, like real estate is not cryptocurrency. Like, it is a long game. Like, the moment you buy it, you have to wait 4 years before you fully see the realization value. Anyone who thinks I'm going to buy a property and by next year I'm going to be like crushing it, that is very short-sighted, especially in 2026. So you need to think 4 years. Think the next 4 deals. And so the best thing that you can do is begin in budgeting your allocation. For the next 4 years, from now until 2030, how much money are you going to actually invest into real estate? I mean, you can invest, into the Anthropic IPO, the SpaceX IPO. You can invest into all kinds of different ventures. How much are you going to set aside? Is it 100,000? Is it 400,000? Is it $1 million? So let's just say it's 400,000 from now until 2030. Then on an annual basis, you're thinking 100,000 that I'm willing to commit to every year. So that commitment right there is so important, because you need to create a baseline of how you are going to invest. And remember that, again, real estate deals doesn't actually mean you're buying a property. It just means you're improving your current real estate portfolio. But it means, again, you don't have to buy a property, you can reinvest. You don't have to, you can reposition, or you can buy a live and flip, where you buy it and you hold on 40 years and then you flip it or hold it. Or do you buy it not Han Solo, but with business partners and syndications? Next 4 years, you're also thinking, what are the key performance indicators that you're going to be paying attention to? The total amount of units, the total amount of passive income, the total amount of active income, the total amount of partnerships, the total amount of deals that are optimized, the total amount of deals that I reviewed, right? My total asset value, my total cash-on-cash returns. Also, your learning plan for the next 4 years. Like, how can you improve your real estate general IQ, asset-specific IQ, market IQ, technical skills, operational skills, financial IQ, and then, of course, developing your team. The thing about real estate is it is not track and field. It's not Han Solo. It is football. It is basketball. You need a goalie. You need a point guard. You need a quarterback. You need defensive line, you need a coach, you need all these people to make your real estate deals successful. How can you include, add value, improve your team, upgrade your team? And so another way to look at how to invest the next 4 years is dollar cost averaging. Many of you have heard that in the stock market, right? You just put in, 50,000 every single year, or, to max out your Roth IRA, traditional, and your 401k. Same thing. If you were to just invest 50,000, or in this case, 100,000 a year, every year, consistently for the next 5 years, what could that look like? And in Sacramento, what I've advised my investors and my business partners is, if I had 100,000 that I was going to invest every year for the next 5 years, I would put 50,000 into cash flow, right? Where, again, cash on cash, 6 to 8%, appreciation 2%, amortization 1%, depreciation 3%. So annualized IRR about 11 to 17%, and 15,000 into equity multiple, which is that IPO pop, which it should be anywhere from 65 to 100% return on investment. So if you were to do that, I ran this AI model. If you did every year 100,000, where 50K went to cash flow, 50K went to equity multiple, by the end of 5 years, you should have returned an 87% return. And this is pretty realistic numbers for deals in Sacramento. This is me doing deals in Sacramento for 10 years. This is what I would expect for it to look like. And the 10-year reality, it can be faster, right? Because a lot of people who are just starting are starting from phase one because they have no capital to invest. So what they're going to be doing is doing fix and flips, or they're going to be making money in the stock market, or they're going to be making money in their job, and they're going to be learning about all these strategies. Then you come to phase two, and that's where, again, you get to the dollar cost averaging, where you can do 4 types of deal: cash flow, passive income, equity multiple passive, and also cash flow and equity multiple active. And then ultimately you want to go to optimized trade up and tax strategy. And that takes about 10 years. But the thing is, I realized this last 10 years went by so quick. 10 years goes by super fast. And for many of you, you may already be at phase two, which means it might take 8 years. And the next law is complete a portfolio diagnostic. So for your portfolio, how many of these objectives are you actually achieving? If you were to have a portfolio report card where you have an aggregate portfolio, not just net worth, but portfolio cash on cash, portfolio debt to income, portfolio any other of these KPIs. And next, commit to the opportunity principle. Many folks are like ideologically committed. I just want to do Airbnb, or I just want to do like glamping, or I just want to do multifamily, or I just want to do like this live and flip, whatever. If you have that mindset, at least in 2026, 2027, you may be waiting for a long time. So I think much more important is to look for good ideas, good opportunities, and be able to know what is a good opportunity to be able to strike. Be able to know I'm leveraging the greatest market opportunity that has been presented to me. I'm leveraging the greatest relationships that have been presented to me. I'm leveraging, this is probably the best risk-adjusted return that I could achieve right now. This is leveraging all of my greatest competitive advantages. And don't be committed to any one ideological asset class or strategy, because you're going to be waiting a long time. And even those strategies may actually not pan out. And also, when you think about portfolio cycle, you want to be thinking your entire deal life cycle. Many folks start off passive because they have a full-time job. Ultimately, they get to active because they want to unlock the unlimited depreciation. But then once they're 70 years old, they go back to passive, right? You may want to start off, you're just getting going, you may want to start off risk off. You don't want to lose all the money that you've just been saving. But then at a certain point, you want to start taking bigger swings. But then once you're 70, you want to go back to risk off. Many of you who are just starting may want cash flow. At a certain point, when you have enough cash flow, you want the equity multiple. You want to be part of the pre-IPO pops. But then when you're 70, you're back to cash flow. Many of you are starting off where I'm going to buy property in Bakersfield, in emerging markets, and eventually you want to be in blue chip markets. So big idea number 2, as I mentioned, is rethink your investment thesis. So there has been 6 moments where all of my most sophisticated operators and investors have rethought their investment thesis last 10 years. Pre-pandemic, before the pandemic ever happened, we already had an investment thesis that was pretty much consistent post the GFC, Great Financial Recession. Then during the pandemic, the investment thesis changed. Like, okay, investment thesis changed. Then after the pandemic, investment thesis changed. Then after the historic rate hikes, 11 times Black Swan event, and then the Trump tariffs, and then of course the Great Stall. 6 different moments where if you were operating with the same investment thesis, then you were operating on like an old operating, mindset. Number 2, you need clarity on your investment thesis, which means your buy box and whether you're going to be offensive and defensive. So here are 10 factors of your buy box. Like, who can raise their hand like, I know exactly what my buy box is? So yes, this is going to be a great presentation, great slide. So here are 10 factors of what you should consider in your buy box. Number 1, your geographic market. Are you going to be in backyard, right? Or is this out of town? Is this a blue chip market or is this emerging? Is this growth, stable, or declining market population? What's your investment timeline? Is this a 2 to 3 year return? Is this a 3 to 5 year return? Is this a 5 to 10 year return? What's your level of engagement? Is this going to be, do you want to get it passive? I want passive income. Or do you want active income? Or do you want semi-passive income? What's the asset type? I'm not going to go into that. What's your business model? Is this buy and hold, value add, fix and flip, ground up development, ADU development, midterm, short term, long term, blah, blah, blah. What's your risk profile? Are you risk on, risk off? What's the deal structure? Again, like, how are you structuring it? Are you putting all cash down? Are you doing conventional loan? Are you partnering up, JVing? Are you syndicating the deal? What's the deal size? What's the deal ROI? And again, for the ROI for me, after looking at just maybe 100 deals, I don't want to say 100, but almost 100 deals in Sacramento the last 10 years, this is kind of what I anticipate for a deal anywhere in greater Sacramento. It needs to be anywhere from 11 to 17% on an annual IRR. If it's higher than that, then it kind of raises red flags. I'm like, okay, really? Show me why it's higher. And if it's lower than that, then I'm like, well, I can get better deals. So I can be very decisive. And most importantly, your competitive advantage, right? Is it off market? Is it creative financing? Is it legal loopholes? Is it close to university or college? Does the deal, can it upzone densify? Main point is in 2026, those 10 factors, you cannot focus on all 10. Then you will get stuck, right? So you have to pick only a couple of these factors that are going to have a higher weight. And so for me in 2026, I chose competitive advantage, I chose geographic market, engagement level, and deal returns. For you all, it may be different. It is completely contingent upon your personal financial situation and your portfolio situation. But what I am telling you is you need to weigh the factors according to your priorities for your goals in your real estate. And also you need to think about, are you going offensive or defensive? So I will tell you, 10 years ago, when I started in real estate, I was offense, 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 like everything offense. I had like no room for defense. In 2026, I will tell you, me and all of our business partners, we are defense, 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 maybe one offense, right? And so for you, you need to also assess how, like, and so are you gonna just buy new properties, buy everything, spray and pray, learn on the job, go into unproven markets, maximize your debt, go Han Solo on the deal, and then high risk, high return deals, and then defense, I'm not gonna read it all, but you get the point. The opposite to that. And you need clarity on your personal real estate goals. And I realized, like, in order to come up with your investment thesis, you also need to know, what are you trying to achieve? Are you trying to become an operator? Are you trying to level up as an operator? Are you trying to allocate capital with proven operators? Are you trying to get that IPO equity multiple pop? Are you trying to get dividend income, right? The cash flow. Are you trying to do tax strategy? Are you trying to use real estate as an estate planning mechanism? So having clarity on your personal goals will also dictate how you ultimately weigh your buy box. And you need to have clarity in your financial goals. And there are 11 financial goals that I wrote in my book. And I really just break it down to financial security capabilities, asset acquisition, optimization, and ultimately asset protection. And I think it's important because not all of it is sequential. Like, in order to achieve number 2, you may need to start with number 4 and then go to number 6. And you want to do a diagnostic in 2026. Like, I normally do this, in the beginning of the year when you're thinking about your New Year's resolution. But before you set goals, you need to do an accurate diagnostic on where do you stand on your real estate goals currently? Where do you stand on your financial goals? What is the realization rate, the confidence score for all of these goals? Rank the importance of these goals, because you can't have all of these goals, right? Because then you have none. If you were to just prioritize one real estate goal in 2026, one financial goal in 2026, what would that look like, and what are the current gaps? And then, of course, complete a financial diagnostic. Pretty basic, but for every property you have, you need this to file taxes. You need a profit and loss statement, balance sheet, debt to income worksheet, and again, all these other questions. And then commit to being strategic. And the main thing I learned when I was at Stanford about being strategic, it is 2 things. Your greatest strength combined with the greatest opportunity. If you only have one, then it is not strategy. You need your greatest, meaning your top 1% skill, your top 1% connection, your top 1% asset, combined with the greatest market opportunity, business opportunity, return property. And once you have clarity on what that could look like, that is a strategic action. And you want to think through that on your deals, on the market, on the investment strategies and portfolio strategies. Okay, in 2026, the only deals that I would recommend doing is super deals. There used to be a time where, again, 10 years ago when I started, I did all deals. Any deal. I'm like, this deal is a shitty deal, but I'm going to do it because I can afford doing it, and it's fine. Call recover. I have the time to do it. I have the money to do it. I'm going to do it. Now, I don't have the time. I don't have the money to do shitty deals. It has to be super deals. So what are super deals? I have 8 criteria. Number 1, it has to be in a good market. When I started off in real estate, I started off in shitty markets. I don't want to say shitty. That's a tough word. Unproven markets. And so it is so important that right now, if you're doing deals, be very mindful. So right now is the market stall, right? Where prices, market correction. Davis, not the case. Davis went up 1% this year. Folsom went up 1.5% this year. Granite Bay is 2% this year. El Dorado, again, up 1.5%. So when people are like, oh, market values are going down, not really for the these top markets in Sacramento. However, you look at Modesto is down 3 to 4% this year. Stockton is down 4 to 5% a year. Phoenix is down 7 to 9%. Austin is down 6 to 7%. So not all markets are equal, and you will definitely, it's more pronounced during market corrections and in this great stall. So what are the 10 factors of a blue chip market? Number 1, there is private investment. Not public investment, private investment coming in. VC capital, economic development plans, there's business growth, there's job growth, there's population growth. Sacramento, we're in good shape. Sacramento is on track of achieving 1% population growth this year, consistently with the last few years, which means 16,000 to 25,000 people are moving to Sacramento this year, right? So that's 1% population growth. That is not the case for every city in Sacramento. That is definitely not the case for all of the states in the U.S. And then public investment, quality of school, blah, 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 blah. And then ultimately, we're looking for markets that have fundamental constraints on new supply, where there's land use constraints, topographic, it's in a hill. So they literally cannot build more without paying incredible cost to level out the hills, or there's environmental constraints or other challenges of why it makes it impossible for national IPO company developers to just build 100,000 apartments that you're gonna have to compete with. So the Davis property, this is a case study, a great example how this year our property value went up. Not just kind of up, it went up $1 million in value. And by it going up $1 million in value, for every single investor that is part of this deal, that is essentially about 30%, 35% increase in their cash flow and all of the above. And so this is an interesting property. We got it off market. It was, we got it for $2.5 million. It's a 12-plex, and our down payment was $1.5 million. That's a big down payment. So what we did was we got 15 people who put in $100,000 a pop. So 15 people, and some of them are here in this room, put $100,000 a pop, but from day 1, we positive cash flow. And so that is why I know that you can still do deals in the great stall if you do it correctly. So next rule is buy Class C property in Class A neighborhood. So we're assuming you're doing Class A market. Class A market is important, but now you're looking about each of the locations, because not all of Folsom is equal. Not all of El Dorado is equal, and same with Davis. So you want to get close to Class A neighborhood, and that is subjective, but you also don't want to buy the flip side is you're buying a Class A property in a Class C neighborhood in a Class C market. That is what you want to avoid. And so this warehouse building for me is still the best deal that I've done, and it's a warehouse in Davis. It's cash on cash is now over 40%. And it's right next to the university. It's Class C warehouse. So it's kind of a shitty warehouse. All of the units are kind of shitty, but it's right next to UC Davis. And so our cash on cash, our vacancy rate is 0%. So we have been crushing it. So next, only buy deals that are off market. If you are buying deals on MLS, Zillow, Realtor, Redfin, and you're paying a realtor their commission, then you are definitely gonna lose money. So you need to buy deals off market, meaning they're distressed, right? And they're motivated sellers because it's legal distress, building distress, or financial distress. They're in foreclosure or short sale, right? And by doing that, you can buy the land 50% on the market value. So right now, for all of our business partners, if it's not 50 cents on the dollar, we're not touching it. Like, we need to be able to buy 50 cents on the dollar, because that's the only way we have that insurance and we have some room for error. And how do you do that? You learn how to be a wholesaler, or you need access to wholesalers, or you participate in deals where the land was bought off market. And only attempt value add plans that you have experience or you have proven operators who can do it, because everything costs more, everything takes longer. And if you are trying to become an Airbnb operator, like, this is not the year to do that, right? So like, if you haven't done it before, then don't do it. Even for us, we have experience doing apartment conversions. It took longer this year. It cost more this year. Everything just took slow. It was just so much more painful this year. So if you're going to do something, you need experience doing it, or you need access to a partner or an operator who has done it. You have to put down 35 to 45% down payment. Otherwise, it just doesn't pencil. There's too many deals that I looked at where it sounds good on paper. Like, this is a fourplex in Sacramento for $600,000. You're like, oh, $600,000 fourplex? That sounds amazing. But when you do just 20% down payment, it's negative cash flow. And so you're gonna have to put an additional, $60,000, so 30% down, and it's like break even. But then you have to put another $120,000 for renovation. So essentially you're putting 50% down for a deal, right? And that is the only way for you to achieve a 4% cash on cash, right? So the idea is, if you think I'm gonna put 10% down, put $60,000 down and get this fourplex, you will be run out of that building way faster than you think. And so, which brings me to the next point, is partner up. You want to, this year, all of the deals that I've done, all 7 deals are with joint venture partners, business partners, or investors. And I'm gonna give you a clear example. If you were to do a deal by yourself, 100%, let's say it's $1 million deal, and you put 40% down, so $400,000 down from day one, 4% cash on cash, 2% appreciation, 1% amortization, 3% depreciation. You have to put 400% down for the 40% down payment, versus if you put $100,000 down in 4 different deals, where you have now 25% ownership in 4 different deals that are cash flowing at the same 4% appreciation, 2% amortization, 1% depreciation, 3%. The idea is you make your equity work for you by not buying one $1 million house, but syndicating your million into $10 million homes with different business partners, because the deal is going to produce a 4% cash on cash no matter what, whether you paid all of the down payment or if the down payment was split with your family members or friends or business partners. And many of you have seen this slide. If you want to achieve proven results in real estate investing, then you need to partner with proven operators, proven partners. That is how you scale faster, diversify faster. That's how you get downside protection and how you maximize your own time value. Next rule is you have to be very conservative in your underwriting. Again, this 11 to 17%, I'm leaning more towards 11%. Right, and this is what I look for in a Sacramento deal. 17% would be when I am, a little bit more aggressive. Now I'm looking at 11%. You need to look at multiple deals. Many of you have been seeing some of my deals. Like, look at 50, right? And once you look at 50, you'll have a good sense. Or look at 20, right? Look at 10, and don't just look at California. Look all over and assess the different pros and cons. You'll have a really good sense of what the numbers are that are conservative. And here's what I look for. Here's my 8 criteria. A market that will always appreciate in value. So Granite Bay, they're not making more Granite Bay land. So Granite Bay is going to continue to appreciate. I'm looking for cash on cash. It has to be better than 4%. Otherwise, I'm going to just park my money in treasury bills. I want to see rent increase capabilities. Will rents increase? I also want to see value add. Can I force appreciate by doing improvements? I want to see product market fit. Just because it's an apartment, that's not always a good deal, because if you have an apartment complex in Roseville, nobody's trying to move to Roseville to live in an apartment. They want a house, right? So you have to have product market fit. You need good financing terms, and you don't want to be over leveraged. You need multiple exit strategies, and you want to vertically integrate opportunities to get paid. And so lastly, you want to stack all of these ideas, right? The what? You want a blue chip market with product market fit, stack 1, stack 2. Then you want to get that property off market with the perfect equity stack. Stack 3, then you want to create value add, a proven value add plan with leveraging all the legal loopholes of California laws, and then you want multiple exit strategies. And when you can stack all 4 of these, now you got a super deal. And those are the deals that I believe they're available in 2026. And the fact that people aren't doing it means more for us, the folks who want to know what super deals look like. So this is an example of a super deal, a deal in Davis that our 4x4 investors are a part of. And it essentially does all of these items, and our return on investment is looking triple-digit returns. And this is right next to UC Davis, their laboratories, and right next to UC Davis campus, and Alan Way's property is right over here. So 8 criteria for super deals. Okay, next is portfolio diversification. Thinking longitudinally. How can you begin diversifying your portfolio? And why? Because we need to be defense first. It's not about making money. It's about not losing your life savings. It's also about achieving different objectives in real estate investing and the different tax benefits and ultimately improving your own quality of life. And so when I think about diversification, I want to take a step back. I paid a lot of money for my family's financial advisor and also for me too. And from Merrill Lynch, it said holistic thesis was 30-30-30-10. And again, this is not advice for you all. This is just what I'm doing. 30% real estate, 30% in a stock market, 30% in private equity, and then 10% in bonds or cash equivalent. For me, for my parents, a little bit different. 30% in stocks, 30% in real estate, 30% in bonds, 10% in cash equivalent. But then in my public equities, I've been going gangbusters. I've been on autopilot. I've been on, trading with Pelosi. I've been doing all kinds of things. I'm not going to recommend that. And then, because it keeps, okay. And then, of course, private equity, and that's what real estate is. Real estate is private equity. And so again, this is public equity, real estate, private equity is exclusive. Public equity is open. Real estate is somewhere in between. For my private equity, it happens to be real estate as well. So it's really 60% real estate. And I love real estate because if you read a report from Fed Reserve Bank of San Francisco, the last 70 years of market crashes in California, real estate value in California continues to go up. Even the housing market crash in 2008, 2009, all of the property values in California went up. And why? Because California land is the most finite piece of asset class in the world. In the world. We're not talking about land in Canada. We're not talking about land in Ecuador. We're talking about California land. And also, if it's a rental property, there's an incredible amount of ways for it to be downside protected and upside returns that I'll go into if you read my book. And then it's less volatile than the stock market. It's more control and more value add opportunities, most proven way of building generational wealth, and most ways to make money. Here are 15 ways, again, of how you could be making money in real estate investing. And the reality is you cannot do this all in one property. So you need to think in your portfolio holistically. Which of my portfolios is cash flow, high return but high risk, or high maintenance? Cash flow, low return but low maintenance. Which one is my market is appreciating no matter what? Which one is forced appreciation because I'm doing value add? Which one is earned appreciation because I bought it distressed? Which one is where I know for sure rents are going to increase, right? All these different strategies for your portfolio. And when I think about portfolio diversification, I look at these 5 frameworks. First, level of engagement. Are you going to do it passive? Do you want passive income, active income? Or are you going to be super active or semi-passive? What are your goals? Is it risk on, risk off, balance, short-term, long-term, mid-term, cash flow, appreciation, asset class? There's 14 different asset classes I won't go into, but is it Class A, built in the last 10 years? Is Class B, built in the last 20 years? Class C, older than that? What market? And again, I'm not messing around with emerging markets. I'm just now on blue chip markets. And what phase are you in your real estate cycle? And other diversification frameworks, a lot of people focus on asset class. If you're just getting started in 2026, I don't think asset class is as important as what is your investment strategy and what is your business strategy. And if you have the right investment and business strategy, it doesn't matter what your asset class is, you could be successful. For example, you can have 4 single-family homes. One is a long-term rental, one is a short-term rental, one is a mid-term rental, one is co-living. That in itself is still diversified with 4 different investment strategies. So I talk about this my vineyard because there's multiple different ways that you can make money in one portfolio, in one property. But the reality is for the vineyard, it lost money for many years, so I won't go into it. And then again, there's multiple ways of making money, even passive versus active. And then there's multiple considerations to have, noting that there was a time where you can get all of it, but now you have to kind of pick and choose your benefits. And here are 7 strategies that I personally did for my portfolio in Sacramento that achieved different objectives for my real estate portfolio. And lastly, for this main point is you want to go up the wealth elevator. So this is a book that I read that I recommend everyone to read. Most people start at traditional investing, right, where they have government bonds and their Roth IRAs and equities and ETFs and blah, blah. Then level 2 is you want capabilities. And the capability is where every year you can dollar cost average $100,000, $50,000 into real estate. Where every year I'm going to put $50,000 into real estate. And you're getting experience. You own a couple rental properties. You have connections now to deal sponsors or operators. Then you get to level 3, which is partnerships or syndications, where you're now a general partner looking for limited partners, or you're a limited partner working with a general partner, or you're part of a private fund. And then you want to get to tax strategies, where now you're optimizing all of your tax benefits. And then you want to get to infinite banking, where you're leveraging all of your lazy equity, and then going into like just pure traditional alternative investing, private equity deals, either if it's a startup, it's a roll-up, whatever. And then ultimately, once you're at $3 million, you're back at traditional investing, which is crazy. When I talk to my mentors who are above 3 million, they just actually rather sell all of their real estate, put it back into treasury bond yields. Because if you buy a 30-year treasury bond yield at 3 million, that's $150,000 a year in passive income backed by the FDIC, right? So that's actually, so once you're at 3 million, that's what you're able to do. Most people start here in level 1 and end here in level 1. And so our goal is trying to get to level 7 as quickly as possible. And I believe real estate does that for you. And the way to do it is the next big idea. You have to unlock your superpowers as a real estate investor. So I have 18 superpowers. I'm going to go through it really quick, 30 seconds. Tell me, Sergey, if I'm like, you have to cut me off, okay? Give me like a 2-minute warning or 5-minute warning, okay? So 18 superpowers. I'm going to go 15 seconds per superpower. Here we go. First superpower. This is for your competitive advantage as an investor in 2026. You need to learn to source off-market deals, or you need access to wholesalers who are doing this. Again, you could do it yourself. You can have access to wholesalers or access to deal sponsors. Either way, like if you don't have one of these 3 things, then do not do a deal in 2026. Do not pass go. Right? And then, again, there's different types of distress that you're going to be looking for. If you want to do it by yourself, there's so many tools now. It used to cost a lot to do property radar. Property radar is cheaper. PropStream is like a full suite of services. A deal machine is probably the most comprehensive off-market deal, and then there's speed to lead. So there's all of these tools where they will give you a list of all of the homes that are in foreclosure, notice of trustee sale, notice of default, in auction, tax delinquency, all kinds of stuff. Code violations, probate, that's kind of what I focused on. Improve your deal analysis capabilities. And a lot of people think, oh, it's a deal calculator. Deal calculators mean nothing. I've seen so many deal calculators. They're not very valuable. You need a deal calculation process. So here is my 3-step process. You follow this 3 steps, it will improve how you underwrite and how you look at deals. So step 1 is ascertain the numbers. So there are 4 types of numbers. You need the top line numbers, bottom line numbers, key assumptions, key performance indicators. Step 2, you need to stress test, battle test the numbers. You need sensitivity analysis. You want to look at the returns. You want a feasibility analysis, gap analysis. And then you need to compare the returns, where it's the similar asset with similar asset, similar asset with different asset, similar asset with different market, right, what have you. And so what are the top line numbers? deal cap rate, right? So how the deal is going to perform from day one, right? The net operating income divided by the property value. Then deal interest rate, cash on cash returns, and you want to make sure that the deal cap rate is higher than your financing costs, your interest rate. Then your bottom line numbers, your exit cap rate, yield on cost, IRR, equity multiple, your key assumptions, right? From OpEx, your rental rates, vacancy rates, and the key performance indicators. And then you want to stress test, right? Sensitivity analysis. What happens to your deal if your interest rates go up by 50 basis points, so go down 50 basis points, or your operating expenses increase 3% or go down 3%, or your rental rates go down 2%, or lease up just takes longer, right? Do you have clarity in the business plan? What's your confidence score in the business plan, the value add plan, and does the return hold up with other deals? And again, for me, I look at these metrics. I've looked at almost 100 deals. This is kind of what I'm looking for in a deal in Sacramento. Next, superpower is creative financing. There are 9 types of creative financing strategies that our firm has done that I've been a part of. And I broke it down essentially into 3 buckets: seller strategies, private debt strategies, and lease strategies. I'm not going to review all of them, but I'll just go over the seller strategies. With seller financing, where the owner owns the entire property, so they can be the bank. Subject to, where you're assuming their loan. And then there's other type of assumable FHA and VA loans as well. Next is optimize lazy equity in your portfolio. And so you have 4 objectives. Look at your portfolio when you're doing a diagnostic. Is there any lazy equity that you can recycle that equity into a better deal? You can reinvest that equity so you can improve revenue, right? You're turning your long-term rental into a short-term rental, but you need a pool table and a hot tub, right? You need to reposition, right, your equity, because right now what you're doing is not working. Your Airbnb is not working, so I need to get out of this. I need to reposition that equity and or refinance, recapitalize. Maybe I'm going to put in more down payment so then I can get a lower mortgage rate moving forward with this property, right? And then, so for any of these things, you have to think, what's the downside or what's the upside? And there's a lot of ways for you to be able to leverage equity. I'm not going to go through all of them. And most interesting, again, is this. You have a lot of equity in your IRAs that probably could be making more money in Sacramento real estate. So this is a great story of my warehouse in Davis that we got off market, seller finance. We bought it for $400,000. It's achieving over a 30% cash on cash in Davis. It was one tenant. We took it, subdivided it into 5 different tenants. We had so much profit that we were going to build another office, ADU, but then its cash on cash was only going to be 3%. And so instead, we invested into the Irish Hospitality Group because they were offering us 7%. So we could have built an ADU office where we were going to get 3%, or we can get a preferred return, which is like a guarantee that the general partners are going to pay you at a 7% annual with return of capital before they get a single dollar paid. We're like, this is a better deal. And so that was equity recycle and reposition. And then next rule is optimize your operations. So there was a time 10 years ago when you got started in real estate, you didn't need to be a good operator. You could still make money. Now you need to be a good operator, right? So you need to be a good COO, which means you need to cut expenses aggressively because everything in the world is going to pressure for costs to go up. You need to fight that. You need to renegotiate all of your contracts. You need multiple bids. You need to bill back the utilities on all of your tenants, right? So all of my tenants, I bill back the utilities now. There's like not a single asset where I pay any water, garbage, sewer. Water, garbage, sewer always gets billed back to the tenants now. And then, first of all, you need an accurate understanding of your OpEx. And then you need to do capital expenditures. The idea of, I'm not going to improve my property and I'll be fine. That idea, that is a lazy idea. You're going to actually lose more money and more opportunities. You need to be able to think about what capital expenditures are important, right, for your current business model, maybe a new business model, and you need to plan ahead to integrate new tools, especially AI now, and new laws, and operational priorities that are concurrent, which is the 4 M's. Manage the money, manage the property managers, manage your maintenance goals, and manage marketing. I don't have time for this one. And have an accurate understanding of your operating expenses and rental rates. Be conservative, be accurate. The moment it's off, your entire operations is now just sloppy. learn to syndicate. And I'm excited. I've never actually shared this as a slide. This is a new slide for the new book. And it's what I'm doing, right? Learn to syndicate. That is how you scale. That's how you stabilize. And that's ultimately how you stratify risk. And the idea is you are putting together partnerships to take down deals. And so here's the things that you want to be mindful if you're a deal sponsor. You need to be able to find the deal, negotiate it, lock it down, do all of the underwriting, handle all of the capital, the lender, the private equity, the operations for the value add, operations for ongoing, and have a vision for the exit. So that is what being a deal sponsor is. But I believe being a deal sponsor with the syndication is significantly less risky than you going Han Solo on a deal. And then now there's what I'm doing, which is fund manager, where I'm actually looking for deal sponsors and I'm raising private equity capital where I'm still doing due diligence, still looking, negotiating with deal sponsors, recruiting LPs, educating LPs, informing, communicating, and still handling all of the tax strategies. And these are 5 different ways of how you can syndicate. And there's a lot of different benefits of syndication, a lot of different financial capabilities of syndication. The one that I talked about was preferred returns, where the general partners are legally guaranteeing your return of capital in a certain percentage before they receive a single dollar. And learn to property manage. I know like nobody wants to hear this, but I've now learned from my mentors and investors. I have a client, she's 80 years old, but because she learned property management in her 40s, now she can still be a very sharp asset manager and real estate investor, right? If you don't know property management, you will eventually get scammed. And so it is so important for you to improve your property management. Maybe you don't need to be the property manager, but improve your property management skills from bookkeeping, from vendor-tenant relations, from marketing, from turnaround repositioning, from your building lifecycle issues, to understanding all of the systems on site and systems administration. Like if you can improve your property management skills now, then for the rest of your life, you will be a super real estate investor. And here are 9 existential priorities, and I have like checklists for each one of these priorities for your property managers. You can ask me and I'll send you the slide. And then learn DTRS. I think many of you have already heard me talk about this. This is the holy grail to real estate investing, is learning to do depreciation, at least making sure that your accountant is doing straight line depreciation for every single one of your properties. If not doing accelerated depreciation, then once you fully depleted all your depreciation, 1031 into a new property, and then the new property starting the depreciation cycle again, and then ultimately doing the step-up basis. And what that means, I'm gonna give you a case study. This one I will do. So this is my Airbnb in Davis. It was the top 1% performing Airbnb in Davis. Now it's not. It's like the top 10%. This terrible time to be in Airbnb. I would not recommend Airbnb 2026, even in Davis. It's super tough. Hotels are just getting smarter and more competitive. But I did this Airbnb. I am doing accelerated depreciation, and I went through it. And that's why Tina, I was like, hey, I looked through the scenarios. So its value is, this is old, let's just say it's $684,000 in California. Your accountants will say, well, depreciate the building value around $547,000. So every year I get to write, for 27 years, I get to write off $20,000. Just from one property, I get to write off $20,000 from that one property. However, if I do accelerated depreciation, where I take all of the short life assets, not over 27 years, but over 5 years, then I get to write off $47,000. But then now with the big beautiful bill, Trump's one big beautiful bill, there's bonus depreciation where I could take all of the short life assets in 1 year, meaning I get to write off $239,000. And so what happens is, let's say you have $1 million of Palantir stock, you sell it, you get hit with a $200K capital gains tax, boom, I do bonus depreciation, I essentially wipe that out. But once you use your depreciation, you can no longer depreciate that property anymore. So what do? Then you do the 1031 exchange. And you defer all of the depreciation recaptured. I defer all of the capital gains I've accrued in the last property. And in this new property, what do? I do the depreciation game again. Straight line appreciated or bonus depreciation. And I do that for 30 years until at the very end, the final property, I sell it to my children. In almost every state except for California, Washington, New York, you can just straight up estate sale at a step-up basis. All of that capital gains that you've accrued for 30 years, wiped away. In California, you can still do it. You just need a revocable living trust. Name your kids as beneficiaries, step-up basis, boom. All the capital gains wiped out. Or you can park the final property in an opportunity zone, and after a few years, boom, step-up basis, all gone. Or you sell it to your friend's best friend charity, and all gone. And 15 unique tax benefits and deductions unique to real estate investing, and why real estate is so powerful in building generational wealth. This is from my first book on my 4 cheat codes that I believe that every super real estate investor has unlocked. And you need to be able to have real estate professional status. And not you, but you or your wife. If you or your wife can spend 750 hours in real estate activities, then you can unlock the real estate professional status. Talk to your accountant about that. That means not only can you use the tax deductions and unlimited passive loss activity against your passive income, you can now use it to wipe away your active income, or your wife's active income, right? And that was incredibly powerful if you do the big, the bonus depreciation. And so, case study, married couple, again, you have a doctor earning $600,000, you have a real estate professional spouse, they do the cost segregation, and essentially you can wipe out all of the, W-2 income tax. And next, I've never had this slide before. It's called vertical integration of business models. This is what I've done, and I think everyone could do it. It means you want to, in any deal, you want to be able to do like 3 different ways of getting paid. So for me, I started with BDM, which is I'm the broker, so I get a broker fee on the deal. Then I get a development fee on the deal, and then I get a property management fee on the deal. If you can do that, all you need is 1 BDM deal per year, and you're golden, right? But if you're doing only broker deals, or only development deals, or only management deals, you're gonna need a shit ton of deals. But if you just do 1 BDM deal, boom, you're set. Same with for me now as a syndicator, an ASM deal where I'm gonna get an acquisition fee for being the wholesaler or bringing the deal together. Then I'm gonna get a syndication fee as an asset manager, and then I'm gonna be the property manager as well and get a property management fee. Or I'm gonna be the broker fee, and then I'm gonna be a contractor where I am doing the construction, or I'm the general contractor, or I'm doing the plumbing, or I'm doing the electrical work, or any other operation, and then manage. And the idea is if you stack these business models, very powerful. And this is an example of how we did this and being able to achieve great returns. And we've done it many times. Horizontal integration. Horizontal integration is something that I've learned from my mentors, and I'd say the top real estate operators in Sacramento, is that they want to own all of Sacramento. They have multiple asset classes, and they want to just be the king of Sacramento because they realize that because the theory of operations before was you own one asset class like office, and you own office in all of America, right? Or you do multifamily all of America. The real estate operators in Sacramento, they decided we're only choosing Sacramento, but in Sacramento, we're gonna do office, we're gonna do industrial, we're gonna do multifamily, and we're doing agriculture. And because for them, they realized the operations team to do all of those verticals, it's actually not rocket science, pretty straightforward. And in addition to that, they can leverage their market instinct and insight in this market, and they can achieve incredible cost efficiency in their operations, and they have all kinds of cross relation networking effects. And unlock California laws. So there are some critical laws that are brand new, that are going to be game changing. Many of you know about SB 9, where every single family home can now be 4 ADUs as of last year, right? Not a lot of people know about that. Not 1 ADU, 4 ADUs if your property qualifies, right? Now there's SB 1123, where for single family lots, you can actually subdivide 10 times, 10 different homes, right? And there's all kinds of different laws that I won't go into, but learning all of these laws and integrating them into your investment strategy will be powerful. And ultimately, you want to stack all of these laws. There's the ministerial by right approval, there's the conversion laws, the density laws, the parking reduction, cost reduction laws, and the legal leverage against delayed law. One law for sure is SB 330, which is being able to submit your application from day one, even if you don't own the property yet. For example, we're in contract on a deal, we don't even own it yet, we already submitted building permit applications using SB 330. And so if the city says no to us, then we'll back out of the deal because we already know it's not gonna work, right? Versus getting the deal, then submitting your application. And you want to achieve risk-adjusted returns. I think this is the most powerful superpower if you want to go big, go fast, right? Meaning, you want to look at deals that are doing high returns, meaning double-digit returns, triple-digit returns. There's really only a few, like heavy value add, new construction, fix and flip, Airbnb, or some unique asset type strategy. But the problem with higher return deals is there is higher risk, way higher risk. That's fine. If you're a really effective operator and you can mitigate that risk, or you have access to operators who can mitigate that risk and understand all of the risks, right? The project phase 1 checklist, the ongoing checklist for operations, and the exit checklist. And you can check all of those, boom. Then the high return deals, you are qualified to do high return deals. Problem is, people want to do the high return deals, but they don't understand the risk. Or maybe they understand it, but they don't have access, they don't have experience mitigating the risk. And that's not enough in 2026. Not only for high return deals do you need to understand how to mitigate the risk, you need competitive advantages as well. You need to stack all the competitive advantages that I talked about. And so again, for new construction, we have a list of all of the things that need to be mitigated or say no to the deal. Same with the heavy value add, a checklist of every single thing that you need to do. And same with fix and flips, a checklist of every single thing you need to do to mitigate risk. And for short-term rentals, and you can kind of consider all of these high return deals and what the risks are, and are you confident? What's your confidence score in mitigating the risk? If it's high, then that's a good deal. That's a risk-adjusted returns. And this is an example of a risk-adjusted return deal that I did, that I raised money. Like this was a developer of the ACL, Marriott, and Hilton in downtown Sacramento. They built an apartment complex called Studio 30. They're way above their return profile where they're gonna achieve 200% return on investment. So when this opportunity came, I was like, oh my God, I wanna be involved. Minimum investment was $250,000. I didn't have that money, so I started another LLC and I got $50,000 from my uncle, $50,000 from my dad. I put in $50,000 in my brother, and we wrote the check here. But within the first month of them opening up their doors, they got 100% lease up. 100% lease up, and they are on track of achieving 200% return. So for me, this was a risk-adjusted return. Level up to institutional grade deals. So I was kind of inferring this. What is an institutional grade deal? It could be your deal is institutional level, or you're investing into an institutional level, meaning the financing is way better. You're getting really good interest rates. If you're going by yourself for a residential deal, we're talking about 6.7%, right? Or for a commercial deal, likely 8%. Institutional deals, somehow they get 5% interest rates, right? Some of the deals that I'm part of that are institutional level, 5% interest rate. They're gonna have a way better equity stack where they're putting 40 to 50% down payment. They're proven operators with like deal life cycle, and they're providing predictable returns, where predictable upside, where I think it's predictable, and then on the floor, they're offering a preferred return, which is kind of a legal guarantee that they're gonna pay you a certain amount before they get to take a certain dollar out. And ultimately, you wanna get to building your family office. Everyone here who is here is not here because they wanna be a landlord. Everyone here is here because they wanna be CEO of their family office. And their family office, their main holding company that they're managing, owning all of the various real estates and all of the various assets. And that family office, ultimately your children take over. I'm pretty sure that's why we're here. We're not here because we want to be an Airbnb landlord or operator. And so start your family office plan now. If you're like, oh, I'm gonna eventually get to a family office, then you're not gonna get there. Start with the end in mind. The family office is the first force multiplier. When I raised money for my family, I was like, oh shit, like this is a family office. Like I'm coordinating my family investment strategy, right? I asked all my family, who has a better investment than me? No one else did, so they all gave me money, right? I'm now coordinating how my family is budgeting. And I'm also now coordinating long-range estate planning. On that note, I wanna thank my wife, Taylor, who always supports me and shows up to stuff like this. I love you, my baby. Yes. And there are benefits, right? If you have a family office, you can raise money faster within your family. You can get access to institutional grade deals. You can accelerate growth faster. You can do the Rockefeller method in life insurance, where I won't go into that right now. And of course, the step-up basis. And here's kind of the step-by-step way I got involved. With my family, I just started off with a family office business plan. I sent it to my dad, I sent it to my brother, I sent it to my uncle. Here's the Kim Capital family office plan. What do you think? Right? Then I'm like, here's the profit sharing agreement for our family. Here's now a partnership agreement, and now we're at an operating agreement for our family office. And now we're doing a family capital call. Everyone put in money, right? And then there's roles, right? Right now, I'm all of it. I'm CEO, CIO, COO, CFO, CCO. But eventually, I hope to hire professional management doing those roles. And then ultimately, I am the chair of the family office. And then my kids are ultimately, CEO, CFO, blah, 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 right? And ultimately, as your family office, you want to think about portfolio SOAP, right? Your portfolio stabilization of rents, optimization of the cash flow and equity, automation so that you can just have good quality of life, and then ultimately asset protection. And so you're thinking about, again, if this year you do not do any real estate deals, but you do portfolio SOAP, that is a real estate deal in my mind. That is still you achieving real estate portfolio objectives. And these are 7 other concurrent priorities for portfolio SOAP and asset wealth protection plan that actually I'm going to just go through really quickly in my next time I present. But the idea is you don't need an LLC for every single property. You really only need LLCs for the riskiest property, and you need umbrella insurance. Then at a certain point, you want a holding company and family office, and then you need some trust to begin equity stripping. And the most powerful entity for a holding company is a limited partnership from Wyoming, Delaware, Nevada, Arizona, or Florida. It has the strongest charging order protection, and there's 4 different types of trusts, right? And you should have all of them, right? Like the folks who are the most sophisticated have all of these different trusts doing different objectives. And from my experience, the bridge and hybrid trust is kind of what our real estate investors are gravitating towards, where we have all of these different assets, from the stocks to real estate, all being owned by our Wyoming limited partnership. All of the ownership shares being owned by our bridge trust, which then is directed by a revocable living trust. And all we need to do is 1 tax filing for all of this. And okay, so to summarize this, 18 superpowers. If you can do 10 out of 18 of these superpowers, you're like demigod level real estate investor. And so I know many of you are like, oh, I'm already there. You're like Spider-Man or Captain America as a real estate investor. If you can do 14 out of 18, you're now like the Thor or Hulk as a real estate investor. Ultimately, you want to get to 18 out of 18 and be full God mode, and you are Superman as a real estate investor. And I believe we can all work together to help each other unlock each other's real estate superpowers. Lastly, I'm going to go through really quickly, is level up your basic business skills and entrepreneurial instinct. And here's one thing it took me a long time to learn. Real estate investing is a high-performing business. And so if you're not operating as a high-performing entrepreneur, founder, CEO, then your real estate portfolio is probably going to suck, right? So you want your real estate portfolio to crush it, then you need to be leveling up as a CEO, leveling up as an entrepreneur. And so do quarterly business planning. I don't know how many of you do quarterly business planning. I think it's so critical now that I'm not doing annual business planning. That's like, annual is outdated information. So I have 4 different business plans. I have for each property that is the riskiest property. I do a portfolio, holistic business plan. Now I'm doing operations because I have a property management company. So property management business plan, and I have a family office business plan. There's 4 concurrent business plans that I'm thinking best case, worst case, practical case. I'm trying to think about what's my critical path, what's the clarity score, confidence score, and again, am I growing, optimizing, transition, diversification, or SOAP, and what are my long-term alignment? Do monthly budgeting, right? Budget in advance of next quarter, right? For how much money are you going to spend on growth? How much money are you going to spend on optimization? How much time are you going to spend on properties with partners, not with partners, for your portfolio holistically? How much time are you going to spend on networking, on your own personal education, on unlocking superpowers, right? So allocate your resource in advance. Improve bookkeeping skills. I know that we don't want to go into But if you can't use QuickBooks or Ramps or any of these software, then you are limiting your ability to renegotiate with your property managers. So I think it's very important that you yourself can pull up a P&L, you yourself can pull up a cash flow statement, balance sheet, bank reconciliation, understand it, do the books, and of course you're gonna have to do it every year for taxes anyway, but by improving your bookkeeping skills, I think that's gonna help you too. Level up your teams, the top 5 players in your team, your business partners, investors, connections, contractors, stakeholders, mentors. How can you add more of these folks every month, every quarter? How can you recruit them, right? How can you recruit A players? How can you educate, train, teach? How can you leverage, learn from them? How can you borrow from them? How can you activate them, right? And the idea is, for me, I have a spreadsheet of all of my contacts and I have scores. I have a trust score, sophistication score, favorability score, alignment score, right? How do they score every single month? And how can you improve your relationship score with each of these team players? And then implement the 4DX framework, which is, you have to be a brutal executionist, right? Focus on the most important goal for the month. Don't focus on anything else. Focus on lead measures, not lag measures. Everyone focuses on, I want this much cash flow. No, your focus is, how many deals are you going to review? How many networking events are you going to go to? Lead measures, you have control over that. Have a compelling scoreboard. I mean, I think most CEOs have dashboards. Have one that's simple, that all of your team members now holding you accountable, and that you have a cadence of accountability of achieving these goals. And ultimately, I think as we conclude this, the last rule is focus on executive functions this year. There was a time where focusing on frontline functions like, oh, I want to be a real estate agent. I want to do on-site property management. I want to learn how to source deals. I think that was very important. I'm not saying it's not important, especially if you're a real estate professional, but I think right now, this is the year to focus on deal analysis, networking, underwriting, portfolio report card, tax strategy, all these things that I would consider CEO level tasks and skills. And here's a bonus, right? Some inflation here. So commit to top business principles. Again, there are many top business principles taught at business school beyond, right? 80-20 principle, first principles thinking. I'm not going to go into all of it, but commit to these business principles. Listen to business podcasts. Listen to not only real estate stuff, but improve your business capabilities. This is you have to treat this like a high-performing business. And on that note, that concludes our presentation. Thank you very much. All righty. Thanks for hanging around. So if you want access to the full presentation, I will email you this presentation, which I realize is 10 years of my business IP and my business partner's business IP. The only request I ask is if you can leave a positive testimonial. Positive review. If you could do it directly on my LinkedIn, I will be so very grateful. I will give you not only the presentation, but the book when it comes out. Or you can email me or text me a quick, testimony. It could be short, right? And you can use ChatGPT to write the testimonial. Be like, oh yeah, blah blah blah. Andrew, he has his wife looks hot, or I don't know. Maybe not that. But the main point is you can leave a review. I will send the full presentation to you. And we have a next seminar. This is going to be a Zoom seminar, and we're going to go over the superpowers section a little bit more, and we're going to have guest speakers. So I'm going to have the CEO of Gateway Development. Gateway Development, we just won a $32 million state contract to build affordable housing. And so, yes, thank you very much. Yes, it was 7 years in the works. We had 100 firms applied, and we were chosen. He's going to be one of our speakers next Tuesday. Please feel free to join. And if you want access to super deals, I have a couple super deals in the pipeline. Just text me, say I'm interested in one of these super deals, and I will follow up with you on how you can learn about these super deals, get access to these super deals. And then, join our meetup groups. I have a couple meetup groups. They're all kind of the same. But again, thank you if you can leave a positive review. And then you can download the book that I've already published 2 years ago for free. And then by next month, the 48 Laws book, I hope, will be published. With that, a huge thank you again to Sergey and the Westsac Real Estate Investor Meetup. Thank you.
Thank you so much, Andrew. Let's give him another big round of applause. That was very good. Very good.
Thank you.
A lot of good information. It feels like we can go into detail like for months and years if we go through into each one of those line items. I want to make sure we have enough time for networking, so that will wrap it up for today. Next month is going to be the Super REI Meetup that Eric mentioned. We'll join that event and we'll send out more information about it. And make sure to also register if you haven't. There are QR codes right there on the tables. I'll put it up here as well. I'll send out an email after with everyone's contact so you guys can connect with each other. Thank you again. We can just hang out here until they ask us to head downstairs so they can clean up. And we'll see you again next month. Thank you.